When you look at the standard deduction now, it has been doubled based off of what it had been in 2017. Under the Tax Cuts and Jobs Act, that amount essentially doubled. And what it does then is it allows us to take the standard deduction versus itemizing. A lot less people itemize now. Within that itemizing then, in order to be able to even take that anymore, you have to have fairly large medical contributions in order to be able to take that, meaning you have to have above 7.5% of your adjusted gross income before the medical deductions even become eligible to be used within itemizing. It has to be a fairly large number before that can benefit each of us. Then you have the SALT limitation, that $10,000, which is a combination of your state withholdings as well as your real estate taxes. And then you look at charity and your mortgage interest. When you take that combination together, as long as that exceeds the standard deduction in place for that year, you're able to itemize. If you aren't able to itemize, then we go and look to the standard deduction, which can be beneficial and potentially make use in a little bit easier fashion for those of us preparing taxes, because we don't necessarily have to accumulate all those other items for federal tax purposes. For state purposes, it can be different, but for federal purposes, we generally don't necessarily have to ask for a lot of those items if we know the client could use just the standard deduction.